Well, joining me now from Alexandria, Virginia, Shelby McFaddin, Senior Analyst at Motley Asset Management. Shelby, thank you so much for joining. And as we begin this trading day, what do you make of the latest market action?
Yeah, I think this is one of the first times that we've seen such a significant sort of reaction to something fundamental happening to NVIDIA. So something a little bit more tangible as opposed to either whether it's hypothetical sort of positivity or just sort of uncertainty about some of their different chip designs. So now we're seeing something that investors can hold and something that came directly from management. And so yes, that's going to sort of trickle down through the tech sphere, not just because they're all sort of linked and how they've been moving because of their valuations, but because they really are linked in what it is that they do. So if it gets harder for NVIDIA to do their business, more expensive for them to do their business, that does sort of trickle down into what happens to other US companies that are within that sort of network with them and along the ride with them. And then it sort of goes down with more companies who use those companies' services, right? So it's a first, second, third order effect. And I think that's what the market is processing right off of the bat. I imagine that it might sort of settle down maybe over the day or so. But I would go ahead and say it's not shocking to see this sort of reaction.
Interesting. Shelby, of course, we are in the midst of earnings season. It really just kicked off with some of these banks, and amid all of the busyness between earnings, economic data, and tariff policy, we are also amid a shortened trading week, right, with the holiday on Friday. So I think maybe some viewers haven't realized that to the larger extent here. But based on what we see happening with tariffs right now and how these companies are starting to pause some of their guidance, what does that portend?
Yeah, I think it's completely reasonable. As a team, many of us are expecting that companies we follow and companies that we're interested in are going to potentially change up some of their guidance. They might pause it. That's going to potentially be across the board because right now they're not really sure what they're facing. The environment, not just in the realm of their stock price, but the macro, the administrative environment is extremely volatile compared to history, recent and moderately recent. So I think at this point, it's not really shocking to us. And typically, we use what they tell us as like a base case, right? And then we kind of, make our scenarios around that. And if they decide to pause that, well, we have to just start kind of changing how we might be running our scenarios, looking at our exit multiples, looking at different discount rates. But at this point in this environment, it's not shocking to see management doing that. And in many ways, we'd appreciate it because it's a bit more conservative as opposed to trying to get too far ahead of themselves.
Yeah. Any signs specifically from the bond market, Shelby, that you've been watching? We've been seeing the bond market come more into focus the past 10 days or so, especially as it relates to what is playing out for equities.
Mm-hmm. Yeah, at this point, we have seen the sort of break, right, in the typical relationship between the bond market and the equity market. And so what I'm seeing right now is that the bond market is really kind of reflecting this volatility and uncertainty in the macro. So if we sort of just like set the equity market aside, what's happening in the bond market is a constant moving up and down because the things that normally would affect interest rates, we've introduced a sort of new set of concepts that can have an impact. And so what we're now seeing is that, okay, we're not really sure what the long run is going to look like. We're not really sure about the government's capacity and about corporate capacity to make back these payments. We're a little bit concerned. We're going to go ahead and raise those yields. And then separately here, the equity market is also facing the same sorts of macro concepts that would simultaneously bring equity valuations down. So we can continue to watch it, but in many ways, it's a little bit less of an indicator right now than just going ahead and looking at blunt force interest rate data from the banks and just different, rather from the Fed and bank performance and macro indicators. So because of that split, it's not quite as much of a predictor, I think, as it would normally be. But it's still something that we are paying attention to because we have to, right? Some of the best companies are continuing to use debt to finance their growth and stability.
There's a lot of concern out there, Shelby. We see it in the consumer sentiment. We see it in survey data among executives as well. So from an institutional side, to some extent, obviously a retail side as well. That people are concerned about a recession. They're concerned about higher prices, specifically because of tariffs, and even the Fed has had to address that as well. Do you think a V-shaped recovery is possible insofar that really the president could change all of the tariff game and get some negotiations underway, basically, and then we could see a different story play out in terms of the sentiment and, of course, performance.
Sure. I mean, I was just chatting with someone the other day about the fact that there's this little chance, right, that we sort of bounce back from this, that decisions are made, and that different parties around the table sort of come around and we're able to get out of this. There's a chance. We don't know how big that chance is. It could be very, very small. But that would be what sort of leads to the V-shaped recovery, right? It would be something that sort of bounces the market right back to where we were. We don't know how likely that is. It leans on unlikely. But sentiment, where sentiment comes in here, is it determines or it impacts that consumer behavior, that household behavior. So you could have plenty of employment, and people could be living pretty comfortably, but if they're constantly concerned, as you mentioned, they're not sure, they're just feeling worried, they might just pull back their spending while they still have plenty of employment and while they still have some savings. And that is what sort of puts the economy right over. That's the tipping point. And so there's this chance that we bounce out of this, but I don't think that chance is going to be based on consumer sentiment. I think it'll be based on consumers seeing the administration make a pivot, and of that pivot certainty, we just don't really know.
Shelby McFaddin, Senior Analyst at Motley Asset Management. Shelby, thank you so much for joining.
Pleasure.